Okay, so the Fed changed the rules. They changed the rules again. And yeah, let's take a look at, I guess, let's take a look at the market now. Has rebounded today up a bit. So I guess just Elliott wave kind of look. Um, this looks like an expanded flat, which you might see a five wave, something like that. From the Elliott look, but regardless of a normal kind of movement, which we haven't seen a whole lot of. The new rules that the Fed announced, there's a few things actually. I guess the big one now is they're going to start buying individual bonds instead of just bond ETFs. So they announced a couple months ago that they're going to start buying junk bonds in addition to the investment grade, which means just the top tier of bonds that moved from investment grade and got downgraded. Uh, they're buying ETFs that include those, but now they're going to start buying individual bonds, whoever they want or whatever. So um, that's not really too much of a surprise or much of a change in what they're doing. So what they're trying to do now, instead of bailing companies out directly that get in trouble, they're trying to buy enough bonds to create private liquidity so that companies can get private funding. And so they'll probably do all of the above. But bailout's kind of a dirty word right now, and it's kind of politically messy to do bailouts, whereas it's a lot easier to do. The Fed can just do bond buying on their own. It's easy to do, and it has pretty much the same effect as doing bailouts with less political stuff. So that's what they're trying to do they're just expanding their ability to do bond buying for bailout purposes, basically. And so, in addition to bailing out the entire worldwide monetary system and blowing the balance sheet to like 7 trillion, like this, they just expanded not quite another trillion. I think it was 750 billion, um, which is I mean, it's huge. Like they're nowhere near that number on bond buying. I mean, they just have a sheet of like some equities that not equities. I'm sorry, of like bond ETFs that they've been buying now, and that's a huge, huge mess of bond buying that they could do now. Uh, right, and also a couple other things they've changed. Retirement accounts like 401ks now can invest in private equities, so good job now. 401ks are allowed to do way riskier investments with higher fees, so that sucks for your retirement accounts. And that's a continuation of the same kind of shift where kind of safe things like bonds are getting lower and lower yields, and people are continually being pushed out the risk curve, or they have to do more risky stuff. And this is just another push out the risk curve, where the retirement accounts are higher and higher risk. So retirement accounts were already scary, risky, and now they're worse. And um, yeah, the bailouts. I mean, I think the bond buying doesn't really change that much because any of those companies that they would have bailed out, now they're going to try to buy bonds to avoid having to bail them out. I don't think that changes a whole lot. I think it's just a little bit less political and kind of easier for them to do bond buying than direct bailouts. And then the other thing, oh right, military contractors that have been affected by COVID. Now there's new bailouts available to military contractors. So um, anyway, here comes a whole mess of new money from the Fed to bail out all kinds of stuff, and everyone's saying now the stock market's rebounding because the Fed's injecting a ton more money. And as of right now, the Fed hasn't injected any more money. They've just changed the rules on what they may do. And so let's see let's see what the market does now. So this breakdown below the average is now rejected, and yeah, I was saying this just looks like a pretty standard flat. That was a poor drawing, but this looks like a just an expanded flat, and you kind of get a 5-wave. And since this is a bit lower, the 5-wave's a little higher, something like that. That's kind of the area to look for as a 5-wave up here. And then we have our Volmageddon line. This is a 2-year bull market support line that we've broken here and backtested really hard here. And in the bear market case, there's usually one or two. There's more often two tests of a trend line. If you're gonna break down to the next trend line, it's more often that you get two reactions. And so I guess now we're back in the territory where we're looking at where we're headed. And so if we're headed in the bear market case, headed here to backtest this and break down, or are we gonna just go straight bear and slice this one and backtest this one? So basically in the bear market case, we're looking to backtest one of these long-term bull market trend lines. And this is the 2-year trend line up here from the bottom of the 2018 bottom. And this is the 12-year trend line from the bottom of the financial crisis. And so that's the zone we're in between now, and we're kind of back in no man's land here in the middle. And so the immediate move is highly unpredictable. I guess in the bear case, after this move, I think the bear case is more likely to break down this way and backtest this one from here, based on this action. And if this is just a normal if this is just an expanded flat continuation, that's just a bearish continuation pattern. So there's nothing here that indicates really, from the technical perspective, it just looks like a normal flat there. But from the Fed coming out with news that they're changing all the rules, people are going to be expecting a big, blow up. And yeah, so let's take a look. Let's just take a look at what's going on. So I closed some shorts around here, and I started to go, like, I didn't think it was going to break down that fast. I thought we would get a longer continuation kind of pattern here, maybe Tuesday, Wednesday kind of thing. But I guess we kind of are getting that now. But yeah, the volatility is crazy. Like when we got this move, that was like a really big, crazy, volatile swing when this little thing happened. Look at this. This is crazy. Okay, so let's take a look. Let's take a look around and see what the actual volatility looks like today. The volatility of volatility is coming way down. Okay. So this is basically the danger measure. Vol of vol is kind of the downside risk measurement, I guess. Look at the VIX. All right, so the VIX is the measurement of how big of swings to expect in trading. So the higher the VIX goes, the bigger moves you can get. And also, kind of down here is bull market territory on the VIX, and up here is bear market territory. So we're up in bear market VIX territory. And and so that move up is kind of chilling the VIX out a little bit. So I guess this is not really a good spot to make any kind of moves, I don't think, in the bear or the bullish case. So, I guess the bullish case is just that the Fed is in control of everything and the market's going to go up regardless of what happens. And let's see what's going on with Oh, okay. Yeah, so small caps are making a big move. That's interesting. And financials pretty big. Okay. Yeah, so this is this is super interesting and crazy. And so there's really no indication of what's actually going on here. So I mean, obviously the bullish case is to go up in either case, and the bearish case is not really to go up. The bearish case is to backtest one of these lines. So from here, I mean, you can get up directly up, and backtesting that means you break it and come back up. So the odds of a move up are higher, I guess, in the short term, in the immediate, like 2 to 3 day term. And whether the whether the market is bullish or bearish, I guess, depends on your whole philosophy of if the Fed is actually floating the market or if this is just a bear market. And I think this is just a bear market, and I think we're just backtesting. I think that we're just backtesting this line now. And so whether we test it once or twice, I'm not sure. But I mean, we are back up here in the range where we could test it again. So yeah, that's kind of a look. Fed changed the rules again, kind of. I mean, they were gonna bail. Yeah, they're gonna bail out those companies anyway. They're just gonna try to do bond buying instead of bailouts, and that's what they've been doing since way back here. And this isn't changing. Well, I wonder if I mean they have like an open market purchase sheet where they purchase like a small amount of this or that, and maybe they're going to add some individual stocks to that purchase sheet. Now, if I had to guess, probably the primary banks. Like that's probably what they're doing. They're probably just adding some primary banks to their sheet, because the other stocks that are in that category would be like the big corporate kind of tech companies and stuff. And I don't think they're going to need to do that. What I think is going on here is the interest rate outlook right now is super bearish on financials, and I think that this move, and I just thought of this like as I was talking, so um, with a grain of salt, and this is not investment advice, the bond prices and the interest rates right now are terrible for financials, and I think that they're going to add primary dealer banks to their individual purchase sheet, because if you buy those, the corporate bonds, like they're going to buy a little bit of high yield and stuff, but most of the bonds they're buying are the investment grade bonds. And if you buy the investment grade bonds, that's a mix of a bunch of infotech stuff and financials. And I think they're really just trying to backstop financials right now because of the interest rates. So that's what I think. And I think they're going to add the primary banks to their bond buying sheet and start just adding a little bit of punch, a little liquidity to backstop the banks, because this entire situation, the worldwide credit contraction, is affecting financials in the entire world, but the really low interest rates that are maybe even going to push negative, and they're saying they're not, but they are dropping. They're dropping. So, um, yeah, if the bonds trade where interest rates should go negative, then the Fed's going to announce that they're negative. Like the Fed doesn't really control the rates; they just kind of guess where they're going to go, and they just follow the bond trading. And the bond trading is just based on inflation and GDP, and we have terrible GDP right now, and kind of unpredictable inflation. So that I think the Fed doesn't even know where the rates are going, and they're just kind of positioning in case. I mean, basically, either if they go up or down, either way is kind of bad, because if they go down, they're going into negatives, and that is terrible for financials. And if they go up, we're getting into inflation territory, and that makes the debt burden a huge deal. So yeah, so I think they don't know where anything is going, and either case is kind of bad from here. And that's what I think they're doing right now. Is I think they're going to add primary dealer banks to their purchasing sheet, just to make sure that these banks have enough liquidity to keep functioning, because that is the whole situation that's going on now. Is all of the banks are having liquidity problems, and they need the banks to be able to provide liquidity. Okay, so that's what I think is actually going on with this bond purchasing announcement. And I don't think. Ooh, so hmm, if that's true, then we might be in another liquidity squeeze right now. If they think that they need to buy financials, because that's actually like half the companies on that bond purchasing list, and if they don't want to buy the ETS, that means they're probably targeting these financials directly. And that means that there's a liquidity problem with the US banks. That's actually what I think is going on. Um, and if that is what's going on, then uh, hmm, that could be added risk for another liquidity move. Where, well, what am I even looking at here? The XLF. Yeah, that could be another liquidity move. So, this big sell-off here is a liquidity squeeze in the international monetary system. And so the international banks basically just froze up, where they couldn't function and couldn't issue credit. The repo market wasn't working. They couldn't swap collateral and cash. Like, the international banking system just kind of stopped working and froze up. And the Fed stepped in and provided liquidity here. And if the Fed is stepping in and providing liquidity here to the USA banks, which it looks like that's what they're doing, that could be a little bit scary. And generally, the Fed does not go and actually buy stuff up or pump liquidity until the problem has happened. Like, they're preparing for a problem that hasn't happened yet, and they usually don't respond until after it does happen. Like, they don't do that in advance. They prepare, they change the rules so they can respond, but they don't respond in time ever. They're always late, and they always respond after it happens. So I think there's a higher risk now of USA banks having a liquidity crunch. And where are we on the timeline? Like mid-June. Like, yeah, I think we're kind of running out of time to have a liquidity problem. Like, I was expecting if we're gonna have more of a liquidity crunch and a deflationary kind of thing, it would follow through in this kind of zone. And now we're it's kind of late. Mid-June is late because this cycle kicked like 20 Feb. Yeah, these cycles are usually only like 3 months. We're already past that mark. We're pushing into 4. So yeah, I think it's getting late, and it's kind of a low probability of having another liquidity kind of crisis. Um, but that announcement today, I think, dramatically increased the odds that that could happen, and that they're worried about it happening. And I haven't seen any news like from the repo market or anything like that with bonds going crazy, or overnight rates going crazy or something like that. But I'm going to keep an eye out and see if anything like that happens over the next few days, because that would make more sense. Like, why would they need to do this, or why would they even be worried about doing that? Like, the things that they're looking at buying individually, they already had a policy to buy ETFs that had that, and now they're just like, well, we're gonna pick and choose. And you know exactly what they're picking and choosing. They're looking at the primary banks and the financial system. So, um, yeah, okay. So I'm gonna keep an eye out on that, on the bond rates, and see if there's any other nonsense or craziness going on in the repo market, because the repo market was really what started this whole mess last year. And yeah, all right. So I don't think there's too much else to look at. I guess let's look at puts and calls, and let's look at the bonds, I guess. Um, okay, so on the, like, we got to a record call ratio where it's like a historically high percentage of calls right before the crash, and it was not just a historic ratio. It was like 12 million call options that people bought before the crash, and so they all got crushed, and then people went short, and now it's reversed, of course, because people went too short. So watch this. So like this kind of call ratio is not indicating anything. It's just kind of in the middle. And if we look at the spreads, this is the 530, and so this is the yield spread between like 5-year bonds and the 30-year bonds. And so the spread is still we had a little bit of a move up, but generally this looks like a down move. That looks like it's still trying to steepen right now. And I guess let's take a look at maybe like 2 to 10 here or something. I think 2 to 10 is probably a better spread. Yeah. Okay. So the same kind of thing. Um, so it still looks like it's trending more steep in general, but we got this kind of bear trap shape here with this double bottom. That's a dangerous shape for a potential reversal here. And like here's where the yield curve inverted, and that's what, August of last year. Okay, so so here's a peak. So the yield curve inverted right before the repo crisis right here, and then the yield curve peaked here before our big crash, and now we're getting kind of this kind of bear trap shape. So if we go back up here to the top of the trend line and we get another peak here, that could precede another kind of crash, I suppose. But right now, the yield curve is flattening, and we'll have to see if it continues to flatten or not. But it still looks like the general move is to steepen the yield curve, but not today. Not today. And this move up today has barely affected the yield curve at all. So I think that's an important thing to watch, is the yield curve. And the DXY is still trending opposite of the market. Right, yeah. So yeah, the DXY came down and the stocks went up today. So this is not useful really as a leading indicator. It's just kind of swinging opposite of the market. Although the Japanese yen did lead. So the yen's just kind of sitting there. That's not. Yeah, there's really nothing that's giving a decent indicator of what's going on. Right, the VIX came down a little bit when stuff went up. Yeah, silver. Oh, silver bounced back up a little bit. That's interesting. Okay. Yeah, gold's just kind of sitting there. I don't think we have any indicators really of what kind of move to expect from here. I mean, we're just kind of in the middle of the range with very little indication of what this is trying to do right now. Yeah, so I'm not going to be changing anything right now. I'm not trading today. I am just looking at hopefully the indicators will indicate something useful soon, but probably I think just on the Elliott waves, I guess. Um, the best indicator that I have, I think, at the moment is that we're in the middle of nowhere, and this is probably just a 5 wave off an expanded flat. So you just get an expanded flat, and you get a 1, 2, 3, 4, 5. I think 5 here. I think that's a good target. Um, Probably overnight, and probably that will completely resolve itself, and it doesn't even matter because no one's even going to be trading while that target happens. Um, so probably just check in, yeah, overnight and pre-market, and this market's so nuts. It's so nuts, and like these kind of swings are just kind of normal now. Massive. These are massive swings that would take like months or something. Previously, over the last 12 years, like this kind of move would take like 2 months. Now it takes one day. It just takes a day, no big deal. 200 points, whatever. It's crazy. All right, so yeah, Fed is going to continue changing the rules like that. They're going to continue buying up whatever they feel like they need to buy up. And this is the same thing that Japan did all during the Japan Nikkei bubble crash. Like they kept buying and buying and buying it. Doesn't matter. And this is the U.S. did all this stuff, the same stuff during the Great Depression. They were doing all this intervention and buying stuff all during the Great Depression. Didn't stop the bubble from unwinding in the Great Depression. And so, yeah, I know everyone thinks like the Fed can just buy their way out of any problem and like, oh, this thing's gonna go up to infinity. But yeah, we'll see what actually happens. I mean, anyone thinks that this market's safe because the Fed's announcing that they're buying some bonds. Like, I think you're mispricing a little bit of risk there. But as far as the actual bubble unwinding, it's not really a standard kind of pattern. Not yet. But if we break and backtest this thing and swing here, it'll get a lot easier to predict. So that's just kind of a look at the bubble model and whatever, the Fed nonsense. So this is not investment advice. Please hit the little button thing and oh man. Yeah, that's all I have. That's all I have for right now. Let me see if anything else is going on. And happy trading.